Good evening, and thank you for joining us. You're already in the chat. I have two great guests tonight. I have Dunn Anderson. He's a mortgage officer, mortgage broker. And I have Dietrich Williams. He's an agent out of LA. We're going to talk about a lot tonight. We're going to talk about Bank of America because that's a hot topic right now. But we're also going to answer your questions in the chat. And I'm going to let them just introduce themselves. You know me, I'm Shahida Hill, getting you over the hill to home ownership and helping you confidently buy your first home. Dunn, introduce yourself.
I am Dunn Anderson. I go by the Lone Star on YouTube, your home buying advocate. I'm a former licensed financial advisor, and I am a licensed mortgage broker in Arizona, California, Georgia, Florida, and of course, the great state of Texas.
Okay, great. Dietrich.
Hey, I'm Dietrich Williams. I am a licensed realtor out of Los Angeles, California. Formerly, I used to work in the banking industry. I've also worked for Nestle. I've worked for Sony Pictures. I've done a lot of things. So I'm big on analytics, and I use that to just help inform people of, as Shahida would say, how to get over that hump.
Okay, so great, knowledgeable, experienced people here today to answer a lot of your questions. So we're just going to talk about, so put your questions in the chat. We're going to talk about Bank of America. So I did a video and I did in my thumbnail, okay, it's all about the marketing of it. No down payment, no closing costs, no PMI, right? Because that's how Bank of America was marketing their program. So it's the same thing. However, when you look at the fine print, and Dunn's going to tell you what he saw in the fine print, when you look at the fine print, the maximum you're going to get for the Bank of America program is $15,000. And that's in anywhere. Even Dietrich's in LA. He's in California. So that's even in California. So I'm going to let the reason why, one of the main reasons, other than, him being very helpful in the chat, but Mr. Dunn was like, I don't agree with this. People aren't going to be ready to buy. They need to have savings. So I like to have different, just so we have a good conversation about these programs. So Mr. Dunn, what do you know about the program and what are your thoughts on it?
So what I gather with the program, I've actually had a client reach out to a Bank of America loan officer actually in Los Angeles. And what she came back with, and Dietrich, we actually discussed this pre-live, there's a $120,000 income cap. And this was just for Los Angeles. There's a 50% DTI threshold. Now that's up to debate because it could be different depending on the area. There is also a max of $10,000 up to $15,000 down or 3%. So meaning you get up to 3%, but you can't go past the $10,000 or $15,000. I guess they base it off of a high cost area. Not really sure. We do have some confusion on what type of underwriting it is. We don't know whether it's going to be manual, and we don't know whether they're going to use desktop underwriting. But they also give you $7,500 for your closing costs. So that's the information that I have regarding the program.
Okay. Dietrich, what have you learned now that the program is rolling out in your city? What have you learned about it?
So similar to Dunn, a lot of the same information. There is a little bit of confusion, and I think that goes across just, different B of A members and reps. One of the things that I did learn about this is that you can use this program to purchase multifamily as well, but there's some different guidelines when you go to use a program for multifamily. So for instance, because they're not looking at necessarily your credit, and when they say they don't look at your credit, it doesn't mean that they are not going to run your credit. They're still going to run your credit. They just will not necessarily take your score into consideration. So they're going to look at like your payment history over the past 12 months. If you have a solid payment history on like your rent, things like that over 12 months, then they will not require you to have reserves for the escrow impound account. If you don't have a solid 12-month payment history, then you're going to need to have 2% in your reserves. If you're purchasing multifamily and you have 12 months of solid payment history, it's 3% in reserves. And if you don't have 12 months for multifamily, it's 6% in reserves. So a couple of nuances there. Some of the stuff is kind of not broadly, not broadcast to everybody. So if you're interested in the program, talk to the B of A rep where you are so that you can get the ins and outs of what the program really entails in your specific city.
All right. So if you thought you were just going to go to the Bank of America and say, hey, give me a house, I don't need anything, that's not going to happen. And we were talking about, is it even practical that this would cover everything for, the average price home in LA? So what did you say about that? Could this buy you, if you didn't want to put, like I said, 0%, zero down, zero closing costs, of course, no PMI, but is it even practical that the $15,000 and the $7,500 would cover everything for a house in California?
It's possible, depending on where in California you're gonna purchase at. So, because here was the misconception that I got originally. Even though the program is in the city of LA, it's the county of LA, and that's a huge geographic area. So, depending on where you're going to buy in the county, it could be enough to cover everything. However, if you are in the city of LA, like Metro LA, it's probably, you're probably looking more condo or townhouse, which then you have HOA. So that's going to be a whole different ballgame in terms of what you're going to necessarily get to qualify for. So it really depends on where you're looking at. And they have a website. I think each rep has their own website that they will send people to. You just go into the website, filter out, you'll filter out to make sure that the house you're looking at falls within the geographic area, and it'll tell you if it does or if it doesn't.
Okay, good. And then Dunn, I know you cover California, Texas, so you have some of those places. Would it buy you a home in those areas? Or Texas? He went over California.
I mean, yeah, it would buy you a home in Texas. One other thing I wanted to piggyback off of, it does give you up to a duplex, but not like a tri or a fourplex. But yeah, that would essentially get you a home in Texas. Right now, you're looking at a median home prices around right at $400,000. So that would afford you the ability to buy it, but it depends on the area too. So I know when I spoke to my client that reached out to the LA representative at Bank of America or the loan officer there, they were telling my client that 75% of LA is eligible. So I don't know exactly what areas are eligible here, but they did specifically point out Dallas, but I don't know what zip codes.
Okay. And the program is really, really new. But we're going to talk about also, so we talked about how it is in Dallas, Texas, how it is in California. But let's get back to your statement in the comments of that video. Right. You were like, I don't think this is a good thing because people won't be prepared. And I know you're a former financial advisor. So what is your apprehension about the program?
Yeah, so it's branded the way it came out. We know that basically it was a what do you call it? Advertisement, right? Like right. All three of us, we could do advertisements in Forbes. It's a press release. So the press release comes out, no credit score, free down payment, just to help minorities. But then you do well, piggybacking on that, that doesn't teach people financial responsibility, right? So if a person has not zero credit, because you could have zero credit on a business and use cash your whole life, there's manual underwriting for that. But if a person has a bad credit score, low credit due to bad credit history, you can't come out and say, well, that doesn't mean anything, because that doesn't mean that you're not going to be a good home buyer or you're going to be able to, hold on to a house. As far as having money saved, everybody needs reserves when you buy a house. When you get into a house, there are issues that can occur. You may be married, you may get a divorce, somebody may get sick, a child may get sick. Different things happen where you actually need money, and sometimes just getting in isn't enough. My third issue was when they said, well, you can buy a house in this area. The issue that I have, the area where I grew up, I guess you would call it in the hood, Oak Cliff, Dallas, not the good part, right over the bridge before South Dallas. Those houses don't appreciate. So if you're telling people that you want to bridge the wealth gap, but you're also telling that person that you have to live in a specific area that may have never had any serious increase in equity, it could be high crime, et cetera. Poverty equals crime. We all know that. So those are my issues. It's like To me, it's a publicity stunt, and it further perpetuates also that, hey, minorities or black folks, they just need all the help in the world. They can't do anything. That's not true. So those are my issues.
Okay, good. And those are valid concerns. Dietrich, what was your feeling about the program when it was released?
So I really have mixed feelings about this because when I first heard it, I was like, this kind of sounds like NACA with a little bit of twist on it. So that's kind of where I was like, well, what's the difference between the two programs? I wanted to get a little bit more information. NACA, I think, is a great program. Sometimes it's harder to get over with a lot of listing agents and sellers. So that was kind of my main concern with this one was, are we going to see that same situation with program? But it's a conventional program, so no harm, no foul. However, the very next week, Citi released something very similar to this called the Home Run Program. And like when I did my video talking about B of A, that's what I talked about at the end was, don't be surprised if you see a lot more companies, a lot more lenders, especially banks, doing this, because one, mortgage applications are down, refis are down. That's a big portion of the business. So in order for them to stay afloat, they got to remain competitive. Well, how do you do that? You try to one up the next bank in terms of what you offer so that you can get those loan applications to come to you. So for me, it was a little bit mixed. I was like, this could be a great program to help some minorities get in the game, although the program is not specifically targeted.
Yes, say that louder, please. Please.
Right.
Say that louder.
It's
program
not
is for everybody.
It's for everybody, right? So
everybody.
So there's and that's part of the misnomer is that a lot of people think it's just for Black and brown people. It's not. It's just for Black and brown areas. But anybody could get this, right? So you have to really pay attention to the wording and what people say when it comes out, because if you don't take advantage, somebody else will, and then you'll wonder what happened. Back to the point though, I think it can be a good program. I'm a little bit concerned about the credit piece of it because this reminds me of what happened closer toward 2007, 2008, when we were doing ninja loans. And if you had a pulse and just wrote down a number, you could get pre-approved for a mortgage. So similar to what Dunn is saying, I think this can be the catalyst that puts us in a tipping point to go back to 2008. I hope that this would not be the case. And I think that's why they're actually test piloting this thing right now, to see how it's going to work before they unroll it to, more cities. So it remains to be seen what's going to happen, but I'm kind of 50-50 about this. I think that it's a great program because it can help, and I know people who could take advantage of it. At the same time, I recognize that this could be a catalyst that sets us up for a disaster, seeing where the economy is and knowing what banks are trying to do just in terms of making sure that their businesses remain solvent.
Okay, very good. And Mr. Dunn's getting a lot of love in the comments. He said, keep it 100. And then somebody said, thank you, Mr. Dunn. I agree. And then thanks, Mr. Dunn, for speaking the truth. So getting a lot of positive feedback in the comments. And I do want to acknowledge, am I loud? I moved my mic up, you guys. Look. You feel like I'm too loud?
Real estate mindset in the building.
Okay, good. Real estate mindset is in the building. He said, what an exceptional lineup. Thank you for all the value you put together for us. Thank you so much, Real Estate Mindset, for joining us. Okay, so we got everybody's. I'm going to put my spin on it. I'm kind of in everybody's camp, but I did a video probably about 2 years ago with my sister. And when the program first came out, I was like, they already do this. They have we talked about this early, they have the Community Reinvestment Act that's been around for a while that will have you in communities that need reinvestment. I don't know if it's 49% or 51% have to be of color, or it goes by the census. But the Community Reinvestment Act has always had loans that were no down payment, no closing, no, they had closing costs, but no down payment, no PMI if you moved in certain areas. Okay, so that has always been the case. I've done videos on that. So I didn't think this was that different. And when I thought about it, I thought about my sister, who there's something in Atlanta called Invest Atlanta. They were trying to get people to move to Atlanta. and they would cover the majority of your closing costs. They were going to cover the majority of your down payment. And they also were going to make sure you had a tax abatement because taxes are high in the city. So they gave you like a 2-year or 3-year tax abatement so you didn't have to pay those taxes. And in my sister's situation, she was a single parent. She only had to come out of pocket $1,500. She didn't buy the house broke, Mr. Dunn. She had money, right? So there was a decision that she made. Let me take advantage of this program. And then my sisters were like, "You're moving to Atlanta?" And she had a daughter, right? "You're moving to Atlanta? What are you going to do? Like, what school is she going to go to? Are y'all going to get robbed on the street?" And those were the kind of things that we were talking about. She was like, "No, I'm moving to the city." At the time, she was working for the city, so she was able to, move. And I have the full video on it. But now she's lived there probably about 6 or 7 years, and that she bought it for about $150,000. That house is worth $400,000 now. So I think if you could, catch these, areas that they're trying to reinvest in, and that's what some people were saying in my comments was, well, it's just going to be gentrification that's going to happen. So I want you at least don't discount all programs because they're coming from Bank of America, because they're coming from different places. This may work for some people that may have everything set up. It may, but always compare it to other things. So I'm never like, oh, this program is the best. I want to put all the programs out there to say, okay, who can use what? And what could work for you, because sometimes something may work for you. And as Sir Ashley had a YouTube reel, it said, use the program, don't let the program use you. Because what Dunn is saying, don't buy it broke, don't go into neighborhoods that are not going to appreciate. Like, be smart about what you're doing. And in real estate in general, you have to buy smart. You don't just, they dingle something in front of your face, come and get this house, and you go running without doing any research. So let's do that. We're going to start taking questions because I think we talked enough. Mr. Dunn, did you want to say something else?
I was going to say, yeah, and I'll make it quick. I'll put the positive spin on it, like you said. I mean, that was great for your sister. I mean, it was definitely smart what she did. But you got to keep in mind that most people don't think like that, right? She had money in the bank. This is what I mean. She was ready. She was already ready. And then she made a good decision on an up and coming area. Like you said, do your research, because that could work out if a person has the right mindset and set up correctly.
And what'd you say again? Mindset. Like you said, we don't have. So mindset, you got to think. And if you don't have the mindset, you need to put people around you that have that mindset. Because one statistic, we're talking about, closing the home ownership gap. And you made a really good point that you're not going to be able to close that gap if you only stay in certain areas, because the property is not going to appreciate. But I had a point. I forgot what it was now. But we do need to close that gap. Like, we all need to be aware that that gap needs to be closed. The majority of people have their wealth in housing, and the gap is significant. Also, the average age of a first-time home buyer in general, everyone is 33. For African Americans, it's 48 years old. That's a huge time. You're almost 50 buying your first house. So we have to be able to close that gap. That's why I love having, other YouTubers on here. Dunn does a lot. He gives it to you straight. I watch a couple of his videos. He don't beat around the bush. He's going to give it to you straight. Dietrich's going to tell you all about living in LA and the right thing to do. But you have to, buy smart. So let's take our first question. I'm going to mind the chat and I'm going to let them answer some. Okay, this is what reviews. I don't know. Sorry, I'm saying that wrong. I want to get a duplex and I have the rent for one unit to pay for the whole mortgage. What loan will I be able to qualify for with no job? You're going to make Dunn mad. Don't make Dunn mad today. Because he said no job. And didn't Dietrich just say about those ninja loans? Any advice? Barely. You're right about barely. You barely getting into real estate. Dunn, he has no job or no income, but he would like to buy a duplex.
Yeah, the only thing you could get is a debt service coverage ratio loan. You need about a minimum of 680 credit score and 25% down, but you can't live in it. It has to be fully rented. You're going to use the rent rolls to qualify. As long as the rents cover the debt service, you can do that. Otherwise, you wouldn't be able to do it. I think there's a little bit of sarcasm in that question.
Okay, he thinks you're being sarcastic. I don't know, though. I don't know. There are a lot of people out here saying you could get something for nothing. Right. All right, so let's see. Put your questions in the chat. I'll put this one up here. Being Veronique, I spoke to one of their lenders because I'm in LA County, and I was mentioning that the average townhouse around me was $700,000. The lender tried to get me go conventional because of my credit. You want to talk about that, Dietrich?
So that was one of the things that was alarming to me, was because the conforming loan limit for us is 647 and some change. And for California, LA County in particular, the median home price is like 830,000. So it doesn't leave you with a lot of options depending on where you're going to buy. Normally, that means you have to go out to kind of the sticks, as I would call it. That's where the program gets a little bit convoluted as it relates to LA. When you're in smaller cost cities or smaller cost states, this program can work wonders, because if you're in a state where the median price is like 450, you're pretty good, right? But if what they're offering you doesn't even cover the cost of what the house is, now you have some different hurdles to climb. So I would say in this instance, you kind of got to look at, weigh what you have, what the program offers, and then what another program can offer, weigh the two out and see which one is more beneficial for you. Because yes, you may not have closing costs, you may not have mortgage insurance, you may not have down payment, but if you can't get the house that you want, that's something else. The other piece is, if you don't have a house, we talked about the wealth gap. If it's not your forever home, keep an open mind, because what you really want to do is just get in the game. Somehow, some way, you want to get in the game. I have a mentor who told me, if you don't have a seat at the table, it's probably because you're on the menu. And for us, that happens a lot of times. We're on the menu because we don't have a seat at the table. So keep an open mind about the type of house, the neighborhood, get in the game. Because if it's not your forever house, you can get in. Just use that to basically create leverage for yourself.
Okay. Your sound went out a little bit, but yeah, get in the game. I like that. We don't want to be on anybody's menu. We want to be anybody's menu. All right. So get some more questions in here. I'm going to mute you for a second, Dietrich. And I'll come back. All right. So let's get some more questions in. But that was a very, very good point about getting in the game. I'm going to ask you this question, Mr. Dunn. Is the main reason to close the gap, do we need more programs? Because I guess this is my thought. Because generations before us were not able to purchase, or it's very difficult for them to purchase. A lot of people don't have, grandma's going to give me $10,000 for my down payment, or grandpa's going to give me, or my parents are going to, cover my down payment, because we don't have that generational home ownership. We're like one generation, maybe two generations in. Okay. I'm like second generation. My mom was the first person to buy a house, and then I bought a house. I did have a grandmother on the other side that had a house, but I don't have generations where great grandparents had houses. Okay.
Right.
So, is the gap primarily because of that? And do these programs help bridge that gap? What are your thoughts on that?
Well, yeah, I think the programs would help. Well, they will help bridge the home ownership gap. And like you said, a lot of those people have $50,000, $100,000. I've had clients that called me in Arizona that their parents gave them $400,000 to put down on an $800,000 house. But that's because they've recycled 6 homes, and their parents before that bought 5 homes. So you're absolutely right. That will definitely actually assist us, Black people in general, in actually, trying to close the wealth gap. So okay. I don't disagree. Some of these programs are definitely helpful for us, especially I don't know if you saw the new program by the, Legacy Loans.
Okay, no, I haven't.
Yeah, there's the guy's Black. He's been in real estate since 1964.
Oh,
done a lot. Yeah, okay. His name's Ben. I forget his last name. He's done a lot. But there are programs that will help. It's all about the mindset in marketing, right? What do people expect from the program?
Okay, good. All right, we have a question from Keith. Currently qualified for the VA loan. Anything else you think I should add to help? African American, disabled vet, maybe grants? So basically, he's qualified for VA. Probably he doesn't have the closing costs. That's what I would think, right? Because 100% financing is good, but if you don't have the closing costs, I would say try to get the seller. Markets are softening in a lot of ways. Try to get the seller to cover some of those costs. Any other ideas?
Yeah, it depends on the credit. I mean, if you have great credit, disabled vet, you probably have a discounted or no funding fee. Like Shahida said, seller credit. You also, if you talk to a broker, I don't know what state you're in, but there are ways to manipulate it where, let's say you wanted to take a slightly higher interest rate. If you got really good credit, you can pay those closing costs. And depending on who your lender is, you may have very, very minimal closing costs anyway.
Okay, good to know. And give Mr. Dunn in this video, in the description, I'm going to have all of their information, a link to their channels. Give them a call after this so you can, get started and get more of your questions answered. And if they can't help you, I'm sure they'll have somebody they can refer you to.
Definitely.
All right. So Marlon, we just got our appraisal back and it appraised. Congratulations. What else do we need to do to get approved for closing? I'll let Dietrich take this one. After the appraisal, what's next?
Now it depends on where you're at. So that piece is a little bit hard to say because how we operate here in California is different than Atlanta and it's different than Texas. So for our closings, you don't go to an actual closing table, right? They send out a notary, you sign your documents, you won't even see the seller unless you have your inspections or whatnot. So you don't necessarily see the seller across from a closing table. After you get your appraisal done though, you want to make sure that you are still maintaining good credit. I will not stress this enough. Make sure you're maintaining good credit because a lot of times people will get the inspections, they'll get the appraisal done, everything is going well, and they're like, oh, we're getting ready to close on the house. Pause. You haven't closed yet. Until you hear clear to close, until you hear we have recording, you have not closed yet. And the lender is checking your credit all the way up until that point. So if you decide we got the house, now I'm going to ball out and go get furniture and I'm going to put it all on my credit, you could kibosh your deal because they're still looking at your DTI and all that debt that you incur getting all that new stuff can be just enough to put your deal underneath the ground. So I would say after your appraisal's done, maintain your credit standards. Just keep doing what you're doing. Talk to your agent, find out the extra things that you may need to do in terms of if you need more inspections that need to get done, if you're still trying to negotiate specific repairs while all of this is going on. It just kind of varies depending on what state you're in. Like, for instance, I don't know if in Georgia you have like septic tanks and wells. Like that's something that we don't deal with a lot here in California. So it just kind of depends on where you are.
Yeah, good. No, yeah, I would say a lot of the same things. Just make sure you're maintaining the same level that you came in with. That's the same level you're going to close with. Don't do anything until you have the keys in your hand. Also make sure that you are giving everything to underwriting quickly because underwriting, you're probably still in underwriting. They're going to be asking you a lot of questions. Get that back to them as quickly as possible. And then I have 2 videos I recommend you watch. Why your loan may be not approved after you get your pre-approval while you're in underwriting, and then what happens in underwriting. I would recommend those 2 videos for you. But congratulations, you should be ready to close. Anything you want to add on that one, Mr. Dunn, as a lender?
I was going to say, congrats, Marlon. Make sure you get with your lender and see what your final conditions are. That's going to be your most important step. Like Dietrich and like Shahida said, don't go out spending money, especially utilizing your credit. If you're doing like any type of gifts or anything like that, make sure all of your down payment funds are actually sourced, meaning that they come from a bank account. You can do a paper trail on them because a lot of people get held up in underwriting because they didn't realize that they couldn't use the cash under their bed.
No cash under the bed. Andrea, can I qualify for a home? Give this one to you, Mr. Dunn, with a derogatory mark. I guess the mark is $4,000, but credit score is fair and payment history is 99%. I guess other than this $4,000 that they didn't pay.
It depends on what it is, but most likely, yeah, you probably could do it FHA. If you're a veteran, you probably could get away with doing a VA loan. Definitely, guidelines are pretty lenient for those type of loans. As long as your credit is like you say it is, if there's not like a bankruptcy within the last 2 years or something like that, you should be good to go. But definitely speak with a lender in your area.
Okay, very good. All right, Real Estate Mindset is back. Who do you see this program? He's referring to Bank of America, truly helping the most. I can see this program being super helpful for single mothers, young couples, anyone working hard, struggling with some savings, etc. Who do you think? I would think along those guidelines, there's a big senior housing is major right now. A lot of seniors who are on fixed incomes, their rent has gone up to the point where they can't afford it anymore. And I'm not saying this program is for them, but I'm almost like a big proponent. If you have a house, you have to start planning for your parents, or you might have to plan for your grandparents, because they may not be able to afford to rent for their whole lives, especially with inflation and food costs going up. There are a lot of seniors in the rental space right now whose bills have gone up a lot. I see a lot of people now working at the grocery store at an older age, getting a second job. So I really want to make sure, if you are in a position to buy, please think about your parents and your grandparents. In our community, especially African American community, that was almost standard, I feel like. And now it's like a lot of them are feeling like I have no place to go, and they have 3 and 4 kids. So what do you feel like the program may help the most, Dietrich?
So I'm kind of with you. Anybody who is basically renting right now, you have a tremendous opportunity. Now, whether you could take advantage of it or not, that remains to be seen. But as Shahida said, if you see that at the table, don't just scoff at it and think, oh, this is, their plight to just help other communities, or this is, there's a lot of buzz that's going out there. She said it best. Use the program for what it's worth. Don't let the program use you. So if you're renting right now and your dream is to own a home because you want to create generational wealth, you really want to start that process up, then I would say, by all means, use what you can to get you to the next destination. It's not necessarily the vehicle, right? It's the destination. So use the program for what it's worth. So again, for renters, huge. If this is a second home for you, maybe not so much, because you kind of have some leverage already, but maybe you still can use the program from that standpoint if you're going to turn your primary into an income producing property. So renters, seniors, this is huge. This is huge.
Just don't buy it broke, right? Done.
No, buy right. Buy right.
Buy right. Don't buy broke. All right. Faith in things. Where do I look to see if an area is growing? I know we talked about areas, and that's not going to appreciate. It's probably, I'll let everybody take a turn at this, but I would look at what's coming to those areas. So when, generally speaking, zoning, they have like 2-year, 3-year plans, or even 10-year plans in a lot of communities. You want to try to get your hands, and usually it's in like planning and zoning. You want to know what's coming to those areas. So it may not be right now, but you have to have an awareness of what's coming to those areas soon, because when major things are happening, they know it years and years in advance, and you need to know that now, as to, what's happening with these neighborhoods in the future. What would you recommend, Dunn?
Yeah, I would say like master plans, they definitely go out a decade. I would say definitely get with like chambers of commerce, because they're in it now. Even local government, reach out to your local government, like councilmen, and just follow the trends, right? Look at the net migration trends. Where's everybody moving up to? Like in, the DFW area, Aubrey, Frisco, Texas, those areas, Princeton, they started booming. But this has been going on since, I want to say around 2009. Now, these are some of the highest cost areas you can move to, and they have some of the most developed and nicest areas. So that's what you want to look at. See what's going on, see what's coming in the area.
Okay. What about you, Dietrich?
I would say look for the signs of gentrification. So if you see bike lanes coming up, if you see yoga studios popping up,
Are you
if
saying
you see
black people don't bike? No.
no, not at all, because we got some in the neighborhood.
Okay.
so look
But
for
you are right. Signs of
yeah,
gentrification, bike
look for the
lanes.
signs of gentrification. Bike lanes, coffee shops. If you see a Starbucks getting ready to come up, chances are the area is getting ready to go through some development. But as Dunn said, just go down to your city, county, whatever it is, go to the county courthouse and ask for the 5, 10-year, 20-year plans. Sometimes you can look them up online and then see what kind of developments they're talking about bringing in. And if you see they're bringing in a bunch of infrastructure type of things, especially when we're talking about malls or major developers that have anchor stores where you see a big box chain or something like that is coming to the area, then you know, like, okay, this area is probably going to be growing really soon. Other than that, as you go around different neighborhoods, talk to people. I have a client right now. She bought in a city called Gardena back in 2017. Well, at the time when we first came over there, I was lucky enough to talk to one of the neighbors, and she said, "Hey, by the way, there's this guy who I guess he owns this company called Tesla. They're going to build a SpaceX plant next door, like near the area." Well, anybody knows who Elon Musk is, you know, SpaceX is huge. But what she said was they have told their employees to purchase in Gardena, Inglewood, and Carson. So those are things that you can't find that out just on a whim, right? So talking to different people, make sure you're networking with different people, especially as you're talking to maybe either developers or investors or just neighbors of areas that you're thinking about going into. So there's always ways that you can find out information. It just depends on how cunning you are going to be to find that information out to help you make that decision.
Very good. Let's do the opposite of this. How do we know when a neighborhood, because I know Atlanta, it was like maybe a 10-year, 15-year plan where they closed all of the housing projects. So all of the house, little by little, everybody got a voucher to buy in different areas, and they closed all of the housing projects. How do we know? So that was a kind of a sign that, you know, things were going to change. How do we know if the neighborhood is going in the opposite direction?
That's a good question.
That is not growing. So I guess no new developments are coming to those areas.
Yeah.
So
go ahead.
No, go ahead, Dunn. No, go ahead.
I mean, I hate to say it, but you can look at like crime statistics. Like you can just look at areas, actually go through the area, see how dilapidated it is. But that could be tricky. Now, if a whole lot of stuff is vacant and falling apart, something may be coming soon, right? If a lot of homes are condemned buildings, they tend to come in and bulldoze all of that and build things up. I saw this a lot in the Baltimore area when I lived there. So that's a tricky one.
Yeah, I would say be in those neighborhoods, talk to the agents, talk to the people, like, because again, people start buying up those things and just holding them a lot of times. And some people can, you know, live there and go through it. And some people can't take the risk of living there and going through it. Right. So just be more aware, get out of your circle of people, go to a chamber meeting. There in Georgia, they're like $25. You don't have to be a member. You can go like to a chamber breakfast or a chamber lunch, and they'll be talking about what's coming soon to different areas. All right, let's see. This might be a Beatrice. Are there any charges if you do an underwrite, basically using two lenders at the same time, going through underwriting with two people? Is it safe to use your builder lender with a $10,000 incentive? I think she's basically asking, should she take the risk of going through underwriting with two different lenders?
I mean, you should know up front whether, you know, with the lender, what they could do for you, right? I mean, you should have all your documents in before you even get your pre-approval. If the $10,000 builder's lender is looking good for their incentive, you need to look at hidden costs, right? See what the points are. Are you being charged points for it on the back end? Other charges, are you paying more in the long run? So you have to do a loan comparison, right? Any competent lender is going to give you a loan comparison. The underwriting is not the issue. If you're ready, you're ready. What you want to make sure is you're not actually getting charged because they're flashing a shiny object in front of you. Most of the time, builders' incentives are not incentives for you.
Okay. So he's saying basically both lenders should give you a loan estimate, and then you compare those estimates. Because what can happen is the builder can offer you a $10,000 incentive or $10,000 toward your closing costs, but their interest rate might be 0.5% higher or a percentage higher. That's how you're paying for that incentive. So you want to be able to compare the prices, because say that $10,000, you may live there for 3 years, and that $10,000, you broke even then, and now you're paying more every year after that. So just be knowledgeable to say, okay, I'm getting this money now, but what am I paying for this money? You want to compare apples to apples.
And one last thing, Beatrice, you definitely want to compare apples to apples. But let's say, they can get you on the back end with interest rates, but also on the front end. A lot of times you'll see, you're new to this. It's your first house. You're buying a new build. You'll see a loan estimate that says $30,000 of closing costs on a $300,000 house. You don't know any difference, but then you go to a broker, your closing costs are $18,000 total. That's the difference, right? They're giving you $10,000, but on the back end, after you equate the money, now you're paying an additional $4,000. You didn't even know it. Because they're saying, look, it would have been $30,000. Now you're paying 21, or you're paying, $20,000. Meanwhile, the broker had you at 17.5. Yeah. Right. So you got to look at those fees that way.
Make sure you're comparing. Yes. And if you want to contact Dunn, his information will be in the comments. All right. We have an Atlanta person, and she's a channel member, and you could join the channel. Hi, Nicole. I'm south of Atlanta and want to apply for FHA loan, but cannot find first-time buyer assistance. The biggest program in Atlanta is Georgia Dream, but I have videos on my channel that have best down payment assistance. And then for every state, I have a link to the down payment assistance programs. But look at Georgia Dream and then look at my best down payment assistance videos. That's where you can look first. And then with your agent, you want an agent that is knowledgeable about the programs that you may qualify for. Okay. Because we do have a lot of them in Atlanta. All right, let's see. Want to purchase, but terrified. Let's talk about this terrified, because a lot of first-time home buyers, like you said, we're buying later, so we can't take the risk of losing any money sometimes. So she says, we're in St. Lucia. St. Louis. I'm like St. Lucia. St. Louis. Thank you, Dietrich. Paying $1,700 in rent. Want to purchase, but terrified. Where should we start? We're 51 and 54. Husband's credit is 680 and mine is 586. I'm going to watch all of my videos. I want to say that, but let's talk about this husband and wife credit. If y'all paying your bills together and doing everything together, I want your credit scores to be closer together. I have a video. It doesn't have a lot of views, but it's about helping your spouse get better credit. Watch that video. And I'm going to let Dietrich take this one. What should they start if they're terrified? And I think the terror is afraid of making mistakes and afraid of losing money and just afraid of buying something that, is going to cost them more money in the long run.
Well, I would say this. So you're married. I'm going to assume happily married because you're looking for a house together. When you first got married, you were probably terrified to go into that decision, right? For us married folks. You don't know how it's going to turn out at the end of the day. You don't know anything. You just take it one step at a time. The house buying process is very similar to that. You have to take it one step at a time. So if you're working with an agent who is both knowledgeable and has kind of that bedside manner, they will walk you through this process and essentially take a lot of that stress off of you. But you have to make sure that you're picking the right agent. Whether you're going to buy in an area that is going to go down in value or go up in value, none of us can determine that, right? Because who knew back in 2007, 2008, and I just told Shahida about this, that the market was going to tank, right? Nobody knew. There's stuff that comes up that none of us can foresee. But I will go back to the point that I just made. If you are trying to create generational wealth, if you are trying to put yourself on an elevated playing field so that you have leverage and that you have options to use in your golden years, because your house, even though you're living in it, you're gonna want to use that as an asset, right? To leverage against, to do some other things against. So I would say the first place that you're gonna have to start is you're gonna have to start right up here. That's the first place that you got to start. You got to start in your mind. And we talked about mindset. Don't approach it as, oh my gosh, I'm going to make a mistake. What if everything crumbles? What if I invest all my money and I lose it? Well, what if it doesn't? What if you invest your money in this house and it appreciates in value and you sell it years later and now your net worth has gone up, 100, 200, 500,000. You have to look at the brighter side of things. Always look at the big picture in all of this. And again, just work with people who are knowledgeable and competent, and they'll walk you through the process. And that's why we do what we do, right? We want to walk you through the process, give you the information that you need to make a very informed decision, and then ease some of that pressure and some of that stress that comes with the home buying process. Because I get it. It's scary. It is scary. It's the biggest purchase that you're ever going to make in your entire life. But if you surround yourself with the right team, if you do your research, if you listen and take the advice of your agent, I can't stress that enough. If you listen and take the advice of your good agent, then you're going to be just fine.
Okay. Any advice done? That was excellent, Dietrich. Excellent.
Hello, Lucy. So the first thing is, the greatest things we accomplish come with the most fear, right? So just piggybacking on what Dietrich said. Now, you guys are 51 and 54. Your husband's credit is a 680, yours a 586. You can get a FHA loan with as low as a 550 credit score. Credit is not an issue. However, what you do have to factor in, the lower your credit score is, you're robbing yourself of creating equity with your home. What I mean by that is, let's say your husband has a 680. Right now, interest rates are higher. He would qualify on an FHA loan probably around a 5.75. But if we went off your credit score, you'd be near 7%. You're buying a $300,000 house. You're talking about a difference in about $270 over the next 30 years per month. That's a lot of money. So you want to work on getting your credit together. You want to talk to a lender in St. Louis, preferably a financial advisor, because now we have to, let me put on my financial advisor hat. So as a former financial advisor, I have to say, you guys need to start preparing for retirement. One of the best ways to prepare for retirement is actually getting stability. Stability is not paying rent, $1,700 that goes up, having to move, etc. As we get older, we tend to not get healthier, right? You understand that. What a house can do, I'm not saying it will do it. If you buy it right, it could potentially bring equity that could actually help you with things like long-term care. So we're getting up there in age. So I'm 40. Retirement. You may have not started saving for retirement yet. Maybe you have a small 401k. Maybe you have a couple of IRAs. Doesn't matter. If you can gain equity over a decade, let's say your house goes up 50,000. Maybe you've done the right things over your life in retirement and you just want to travel. The home can do a lot for you. And at the end of the day, worst case scenario, let's say you buy a house, it drops 50%. You still have your home and you know what your payment is going to be. No one's going to take this. This isn't the stock market. You didn't get wiped out.
Okay. Very good advice. Excellent. And I love the stability in retirement, because if you're renting $1,700 now, imagine what it's going to be 5 years from now, 10 years from now, when you stop working, how much it's going to be. All right. This is a good question from Ina. And this is something I've thought about. We talked about the legacy program. Did we talk about it just before this, or I forgot, or we did it live? Because we chatted a little bit before.
I don't remember, maybe live.
Live. Okay. So we did speak about it. This is my question. How are they checking who's Black and who's not? Are we all going to have to do like a swab and do like an ancestry DNA? How are they checking who's Black?
So here's his loan. His name is Ben. I forgot his last name. They're doing census tracts for Black neighborhoods, and you do actually have to be Black. It's not illegal. It's not a violation. There's actually legislation that he brought up. I actually saw him do a video with the Earn Your Leisure guys. Say what you want about him. But they actually did a video about it, and he brought it up. I looked up some of it. It's legit. They're doing a 1% down payment. You can bring additional money. You don't have to be stuck with 1%, but they are looking at specific areas. It is a pilot program. Again, in certain areas, they do have PMI. You need a 620 minimum credit score. But the way it was branded, and looking at the guy's history again, that's pretty legit. Like, that legacy program seems like something that'll be good, but it's a 3-year test program. It may not last. Just know he is actively trying to do something.
Dunn, is it in black areas or you
Black
have
areas
to be
for black
black?
folk. You got to
Black
be
areas,
black.
black folks. So they're checking the census to see if you're black.
They're checking the census tract to make sure. So it's two ways. It's a reinvestment in the community. It has to be a black area, and you have to be black.
How are they verifying that you're black?
I don't know how they're doing it. Okay. I don't know how they're doing
that's
it.
That's a serious question. I didn't,
he specifically said you have to be black.
Okay, because if you do ancestry, a little bit's gonna come up for a lot of people.
That's the right thing, like Indians.
What percentage black do you have to be? I know for Native American programs, they make you track that back through like the Native American records and things like that. But we have, our history is a little bit more all over the place, right? So Ancestry, he might have to get a sponsor. Ancestry is gonna have to what percentage you come up.
I think that when I listen to it, I think that's the major issue. It might not make it because of that. Because how can you prove? Because you could be actually white and be black. I hope that didn't go over a lot of people's heads.
Right.
You could be two generations and you could be white. Your parents could be black. Like it has happened. So.
Yeah, they would have to do some kind of ancestry DNA. Everybody gonna have to swab and try to get in these programs. I don't know.
Well, I'm actually going to ask. My frat brother is a senior vice president for Legacy Home Loans, so I'm interviewing him. Good. Yeah, I'm interviewing him next week. I will bring up this exact question.
Please do,
and have him give me a straight answer.
A straight answer, then make it a reel. So
exactly.
So we all can see it. Very good question. All right, so CJ, this is from Mr. Dunn. What's any advice for an aspiring mortgage loan officer?
Sign up, study, and take the test. What's stopping you? Just go do it. I will say this, just like any business, because you will be self-generating unless you want to be a slave to a retail organization. Don't do it. They don't pay you enough. What I would say is make sure you figure out how to cultivate a market. It's tough starting out. Learn the business, learn how to help people, and get into it for the right reasons. If you're in it to just make money, as you can see right now, a lot of people, even heavy hitters, they're exiting the business. So you want to do it to actually help people achieve the goal of home ownership. You got to want it sometimes more than the borrowers. Trust me.
And then a lot of commission-based things, we over the last, when interest rates were low, everybody was racking in the money, right? Yeah, racking in the money. Interest rates are low. You could close, pretty quickly. You have to be able to go through those peaks and valleys. You don't go crazy. I'm making all this money. I'm going crazy. And then you're like, oh, I'm not making that much money. So I think in lending and in real estate or any kind of occupation where there's going to be some ups and some downs, you have to kind of balance out your income. You don't ball out because you made, $500,000 one year and the next year you made $50,000. You balance that out so you can cover all of the years and all of those changes. All right.
I would say if you don't have a business, start an LLC so you can get paid through the LLC and then pay yourself out of that. That way you can take bigger tax deductions off of that. Okay.
Deborah's asking, is there any chance that I would qualify for a no money down with a 756 score with a DTI of 23%? I would say yes. What do you say, Mr. Dunn?
Probably in every state that has a down payment assistance program. You're awesome.
You're good.
All right. So another YouTube, we don't talk about other YouTubers. I'm playing. Another YouTuber said the down payment for Bank of America gets included in your income for taxes. Anybody know anything about that?
Yeah, they don't have the answer for that yet. I would love to beat up on Bank of America, but they don't actually have the answer. They're saying it would come as like the form of a gift. I didn't see that, not a gift, but what a 1099. I didn't see that actually on the Bank of America website. I would say call Bank of America, but I doubt it.
Okay, good. All right. He said, is it okay to get better employment while going through the program? So I guess, and this isn't if you're under contract, you're buying a house and you have been pre-approved, can you get a better job? And then they would consider that better job, I guess, during the program. This is my one thing to say, and I'll let everybody talk. Yes, but it has to be the same kind. Because I've had people go from W-2 to 1099 and be like a contract worker. So before they were salaried, right? So say they made $100,000 on salary. And they said, oh, I'm going to give you this contract position and you could make up to $150,000. That's not a good change because that contract job is not guaranteed. And you may have to do that for 2 years before they take that 1099 income. So just be very careful because I had a client do that. They went from like a better paying job, but it was a temporary position that could become permanent, and then they weren't approved anymore. So just be mindful of how you're making those switches. What do you say, Mr. Dunn?
Yeah, don't do it. Keep the job you have while you're going through any program, underwriting. Don't switch jobs, even if it's more money. Don't decide to start a business because they're going to hit you with, well, you haven't been in business long enough for yourself to qualify. So you would need 2 years of history that you can actually continuously earn money while working for yourself. Don't do anything. And the last question you had was, how long does it take with the new income? Again, 2 years. So that's the safest answer I can give you.
Got it. I think that's pretty covered. Dietrich, you want to say anything?
No, I was going to say, I just had this conversation with one of my lender partners, and essentially it's the same info. Now, if you're going from within the same industry and you're just going to get more money, it's possible because it depends on the lender. My advice would be to, if they already offered you the position and you are in escrow, try to hold off on accepting that position until after you close.
Yeah, be safe. All right. I filed this from E. I filed Chapter 7 bankruptcy last year. I have $25,000 in savings. Is that enough for a down payment on a house?
The money is enough, but you need 1 more year out of this bankruptcy. If you file this based on the discharge date, you need 2 years from the discharge date. And then you can go ahead and do an FHA loan.
Okay, very good. Yeah, just know when you guys, I guess when people file bankruptcy, they need to have like a little thing. This is when you could buy a house. But I do have a bankruptcy and foreclosure video as to how soon after can you buy with FHA and how soon after you can buy after conventional. All right, I'm going to come through some more questions. Please keep on your questions in the comments. If we kind of already answered it, we're not going to do it again, but any new questions, please do. Tajana, sorry if I'm saying your name wrong. Tajiana, can you talk about grossing up Social Security income? Also, is it possible to apply and close in December using the projected? She getting all these things. You know what she's talking about, Dunn? I know grossing up, but what is COLA?
It looks like the cost of living.
Cost of living. Okay, cost of living.
Because I think Social Security just learned something. The underwriters that I've worked with, they'll still request that you have that statement, that letter showing what your disbursements are going to be. They have to go by that. But that shouldn't be a problem as long as you get that soon, which you should. I'm guessing probably around the end of the year, January.
Okay, good. So just plan on that. Let me see. Is Mr. Dunn? He just talked about that. He said y'all don't listen to him when he tell you what to do with your money. So if y'all listen to him, he would open back up. Are you taking any financial planning clients, Mr. Dunn?
Yeah, I'm not starting that business. I might do it in another year, but I will direct you to go over and talk to probably do a consultation with. I don't agree with everything he says, but the pocket watcher. Watching with JT. He's all right. He's a legit guy. Check him out. Legit guy.
Okay. Yeah. But let me say this. He does give financial advice, financial planning advice, not official, on his YouTube channel.
Right.
He's going to tell you what to do. He has videos that say, do this, don't do this. So you can, hire him in that way. Watch his videos. Right. All right. So somebody said genealogy can prove it. But I said exactly, but what's the percentage of genealogy? So if we're going genealogy, right? Or he's just saying like, I think it's going to be difficult. All right. I think some people are coming in late. We weren't talking about the Bank of America program. The Bank of America program, anybody can buy, okay? As long as it's in a certain neighborhood based on the census. But we were talking about the legacy program, and the legacy program said specifically it was for Black people. So we were trying to figure that out if you're coming in a little bit later. All right. Let me see. Any other questions? Okay, let's talk about your YouTube channels. Yes, these gentlemen have YouTube channels. You need to shout it out, and I will have it in the description. I just don't have it right now. But go ahead, Mr. Dunn. Tell them your YouTube channel.
All right. It is The Lone Star, Your Home Buying Advocate. That's it.
That's it. Go check it out. Again, I'll have it in the comments as well. Now, the comments and in the description of the video and then in the title of the video, I'll have it. Dietrich, what's your channel?
Real easy. Dietrich Williams, Realtor.
Okay. Yes. And when I remove this question, you'll be able to see the spelling of his name. All right. Let's see. When is it ever better to rent an apartment than to buy a house? This is a good question. Dietrich, you ready? You need a minute. I'm going to let the advisor do it. When should they just keep on renting? When is it ever better to rent? I'm going to say one thing. If you're not in a stable place, so either location-wise, you're not planning on living in that house long, your employment's unstable, your relationship's unstable. If you're in a place of instability, to me, you should rent. What do you have, Lone Star?
No, I agree. If you're not stable, you should keep renting. If you don't know what you're going to do, if you're going to switch jobs, the most important thing would most likely be, your ability to continue paying. Like your job is the most important. I agree with what you said.
Okay, Dietrich.
No, that was it. It was really, are you going to be in your job or what you're doing for an extended period of time? Can you cover the debt service every single month after month after month? Because it's different when you're renting versus buying, right? When you're a renter, something breaks, you call the landlord. No harm, no foul. When you own it, you are the landlord. So you're calling yourself to fix this and fix that and this, that, and the other. So do you have the money to cover all those expenses? So that's something I talk to my clients about a lot of times. Is it's not just the down payment and the closing costs. There's a total cost of ownership. And that includes having the money to know that, okay, if there are certain repairs, I have money in the bank. But if you extend yourself to where all your money is depleted just for your down payment and your closing costs, the moment something breaks, you're going to be at a disadvantage. So if you're not in that type of position where you can afford something like that, then it may be better for you to keep renting until you save up enough where you have kind of that rainy day fund or you can cover emergencies.
Okay, good. Lone Star is going to be right back. He had to take a call, but he's going to come right back. So it's just me and you, Dietrich. Let's do this. Let's see. Next question. Kibri says 40% of Americans would struggle to come up with even $400 to pay an unexpected bill. And a lot of that is correct. A lot of people don't have savings. I know, like, you have to be intentional about saving money. When my husband and I were saving for our house, like, we needed a new printer and ink. I was like, print that at work. Like, we need to save this money. Like, we were very intentional about saving money. So you have to get a point where you're not living. Like, if you're living paycheck to paycheck, no, you don't need to buy a house. You have to have some space in between your bills and like having extra money, some discretionary income, some savings in place. But what do you say to people that don't have a lot of savings? And the way I look at down payment assistance is that you have the money, possibly, right? You have, a lot of money saved or a decent amount of money saved, but this could help you keep some of your money. Like, you use the down payment assistance program and, you had $10,000, but you use some of that money. Now you can keep more in your savings. So I don't look at it as use your down payment assistance and buy it with no money in the bank. It is maybe you can save some of that money so you have that cushion in home ownership. Otherwise, you have to save for the down payment and save for your cushion. Your 3 to 6 months of expenses. What do you say for people? Like, what's a little hack that you have for saving money?
So I would just say one of the biggest things that you're going to have to look at is the sacrifice, right? So for instance, all transparency, I have a sweet tooth, right? So I might go to 7-Eleven and get some juice and donuts. But if I do that every day, that may be like $5, $6, $7 a pop. You do that every day, that's $35 for the week. We're talking about $140 for the month. I could have saved that money up. Now I'm using that. It's a very small example, but if you do that with enough little dinks and dunks here and there, you'll be surprised at how much money you can save sometimes. Now, for people who are living check to check and it's like, we're already stretched, we don't have it to save up. I would say look to finding another stream of income, right? So that's something that you're going to find out that happens with a lot of wealthy people. They have multiple streams of income. So maybe you have to take a second job. Maybe you have to, if you have a certain skill set that you can use that adds value, use that skill set to help monetize and bring in some extra income. And then you can start saving from that standpoint on. But it's one of those, it's kind of rough depending on where you are and kind of what your situation is. So I never try to make light of, hey, just save it. Cause some people it's almost impossible that they can't. But I would say you really have to just kind of sit down. Nobody likes to use this word. It's kind of a cuss word. It's the B word, budget. So you have to look at your budget and just kind of figure out, like, where can we save money at? What can we get rid of? If you got Netflix, maybe that's something that you get rid of, right? It's the sacrifice. If you're eating out every day and you're not thinking about eating out every day, that's money that you could be saving, right? So you have to get in that mindset to start saving the little so that when you're saving the lot, it's not a foreign concept.
Okay, good. I know the financial advisor has a hack. How are we going to save some money?
Yeah, so the first thing you have to do is live within your means. You know, a lot of people, like, they do these polls where it'll say, you know, 40% of Americans struggle to come up with $500, $400 for an emergency. But at the end of the day, most people live above their means. You probably know a person that makes $60,000 a year. They probably drive a nice Mercedes or a BMW, and they live in a $2,500 a month apartment. They have Netflix and they have an iPhone 20, whatever's out. Those people are living in what they think is their means, but you live below their means. And to piggyback on what Dietrich said, you know, many wealthy people, they do have different sources of income, right? But at the end of the day, the people that are truly wealthy, they live to a certain standards below their means, so to speak. Like if you look at Mark Cuban, he really wears T-shirts and jeans, right? If you look at some of the wealthiest people on the planet, they have small houses. They don't all have mega mansions. You know, they don't show their money. So even a normal person that makes, let's say $5,000 a month may show their money. Maybe you're driving if you make $5,000 a month, that's $60,000 a year. You might be driving a Lexus. Do you really need that $750 car payment plus $200 for the insurance? So it's not that people can't save money. It's that people aren't willing to make those sacrifices. And I'll wrap up. I had a client back in the day. They spent $340 a month on Jamba Juice, but wouldn't buy life insurance.
Right.
Jamba Juice in Maryland. Juice. Right. Your sugar. You need the life insurance.
Do they have Jamba Juice in Atlanta?
They might have one or two. They're not that popular.
Oh man. Okay.
I've heard of it before though. Okay. And I'm going to be very transparent with you guys. Most people know who's been on this channel. I used to be a teacher. I was making about $70,000 working full-time as a teacher. I went from full-time to part-time when I was, transitioning into real estate. So I made $35,000. My salary was cut in half. I still live off of that $35,000. Like this YouTube money, this real estate money, our expenses, like we might do like little things, but we haven't increased our cost of living because, now you make, 6 figures. I'm still pretty much living in that same, amount. Like I didn't increase my, what is that called? Lifestyle creep that you have. I've just started, putting that money in other areas, in investments and things like that. But my lifestyle in general hasn't changed. My kids still get like double, like their allowance. They get double their age, and that's what they get for the month. So they're 11, they're getting $22. And so when they're at like the grocery store, I want to get this. Where's your money? Where's your $22? Or go make some money doing something. My son has to sell his video games on eBay to make extra money. So it's like, don't get caught up in what other people are doing and what, you really have to be living for yourself. Just make sure you have, your affairs in order. All right, we're going to take about 3 more questions. This has been excellent, guys. Please follow both of them on YouTube. Dietrich, he's out of LA, and Dunn, we're going to call him the financial advisor, the Lone Star mortgage broker. He's going to make sure your money's right and your mortgage is right. All right, let's see. I saw a good question. I'm going to, sorry, somebody said, sorry, I'm going back up. There was a question that I saw about how can somebody stay in their budget in these high cost areas. So that's the question I'm looking for. Okay, this is what it said. Some people say, don't spend more than 25% of your income. I know who that somebody is. That's Dave Ramsey, isn't it? I'll say up to 35 of your take home pay, but low as possible. How can this be true when decent houses in DC, VA, New York, New Jersey are all over 550,000? I would say this is in my opinion. If the average home is 550, there are some people that probably can't afford that. So your income may be lower than what's average in that area. So that could be, like you said, getting another position, seeing, why you're not making as much. Like I had to change. My income was capped at 70,000. That's a big reason I left education, because unless I got like my doctorate or became a principal, I knew what I was going to make probably for the next 20 years, because we had a salary schedule, right? So in order to make more money, I had to do something else. I didn't want to stay on their salary schedule. So you have to find out what, don't just get stuck. I make this, and this is what I'm always going to make. You have other options. And then the other part of that is, I'm from New York. My mom didn't have a house in New York. It was very expensive. So she moved to Atlanta. And was able to buy a house very shortly after she got to Atlanta. So I'm just saying, one, if you're in a high cost area and your desires for a house, either you're going to have to increase your income or you're going to have to move to a less expensive area. I'll let Dietrich take that next, and Dunn take it after him.
No, you pretty much hit it right on the head. I think a lot of times as buyers, we get so wrapped up in being in a particular area because it's familiar, we know it, we don't want to leave it, and we love it, that we keep a closed mind to other areas that may be beneficial for us. And so, like I was saying earlier, if your goal is home ownership, yes, you have to consider like your commute and all that other stuff, but really, you just want to get in the game. That's really what you want. You just really want to get in the game. So while you're shopping for homes, keep an open mind to those areas that may not have been on your radar, because that area that you just were like, I don't want to go there. You never know. In 10, 15 years, that area starts to expand. There's only so much land in the United States, right? And we don't have a lot of houses right now. So in order for us to build, we got to build somewhere. They're going to start utilizing that land at some point, right? So just keep an open mind, look at those areas that may not have been on your radar. But like Shahida said, you might have to either move out of your area or out of the state altogether if you can.
Dunn, how can they afford these homes in these very expensive cities?
Well, the first thing I have is a question. How many of you have seen, as a kid, you may have grown up and saw an older person in your family that always had the new Cadillac, the nice house, the nice bags, the clothes and everything. But when they got old, they died with nothing. And your mother or father probably had to take care of them. They suffered. They didn't leave anything behind. So that's what happens when you have the philosophy where, like Dietrich said, I'm married to this area, right? DC, Maryland, VA, Jersey, New York, those are high cost areas. But if you don't command the income that will have you living comfortably and where you could save and put away for retirement, take away for things like long-term care, your life insurance, maybe if you have children, save for, your child's future, invest. If you can't do any of that, then you need to move to a lower costing area, or you need to improve your skill sets. It's not about trying to afford where you don't need to be. Don't marry a house, marry your future.
Okay, very good. Love that answer. Let's go. I have a super chat. Shahida, will you be doing the YouTube video series for teachers who want to do more? I need to do that. Stay tuned. All right. Any advice for self-employed borrowers with a W-2 spouse? Let the self-employed person gift you the down payment, and then you go buy the house. That's my hack. What do you have done?
Don't file taxes together if you're writing everything off. Make sure you're not writing everything off. Sometimes you have to go back and you have to redo those taxes, because what happens is when you write everything off, they're only going to use your actual income after the write-off. W-2 spouse is fine as long as they've been on the job for 2 years. If you've been self-employed for 2 years, you generate the income, not a lot of write-offs, y'all have the credit, then you can buy more.
Okay, good. Any advice?
So I'm going to tell you, as somebody who's married to a W-2 and is a 1099, what we wound up doing was of course, her income was cool, but I started a business, right? So as a real estate agent, I don't get paid as Dietrich Williams. I get paid as my LLC. So the LLC takes all the write-offs. I pay myself from the LLC, and I don't take any write-offs at all. So if you're planning on doing this as a married couple, consider that way. If you're not going to start the business, do not take write-offs. It's going to hurt. I'm not even going to lie. When tax time comes, it's going to hurt when you don't take write-offs. But you have to look at the long-term benefit, right? It's only 1 year that you're not going to take the write-off. You're going to take a tax hit, most possibly. But if it's able to get you to the house that you want to get into, by all means, go that strategy.
Okay. And somebody, I don't see it on here anymore, but somebody had asked about, they said house hacking is the answer. Like it's the answer to, affordability and all of that. I would just say this, especially the multifamily, because I know that's a lot of videos about like multifamily, move in one unit. There are not that many, depending on where you live, because you have to live in the house. When you're coming to Atlanta and you're like, because I get calls about this. I want to get multifamily. I need to get a duplex. I need a triplex. I need a fourplex. There's not that many of them. Like you are limiting your scope. It is a good, thing to do if you can find it. So I find people like they get that in their mind and that's all they want. And you may be waiting years sometimes to find that opportunity. And, when you talk about neighborhoods and that sort of thing, they don't put those in the best neighborhoods for the most part, at least in Atlanta. The duplexes, the triplexes, the fourplexes. I know they're more common in the north, but don't make that, you almost have to have a plan A, a plan B, a plan C. Don't make that your only plan. I'm a house hack and I'm gonna get a multifamily or I'm not gonna buy a house. That's when you're gonna be the 50-year-old still trying to get your duplex, the 50-year-old still trying to get your multifamily. It is an option, but don't make that your only option. What do you feel about people that say house hacking is the answer to all, like affordability, to everything?
It can be, as you stated, but coming from, if you're in Los Angeles, we have tons of duplexes and, triplexes and quadruplexes. The problem that you're going to run into with a lot of these is rent control. So we live in a state that is clearly tenant heavy. So when you purchase that property, you're going to be purchasing at the top of the market, but your rents are probably going to be below market rate, because otherwise, why is the seller going to liquidate the asset, right? So in order for you to make it so it's beneficial for you, you're either going to have to buy a really dumpy place and then force the equity by fixing it up, or you're going to have to figure out some way, and I'm not advocating for this in any sort of way, you're going to have to figure out some way to get the tenants out and get new tenants in so you could charge market rate. Otherwise, it doesn't make sense. So I like right now, a lot of my investors, they're not touching multifamily right now. One, because the cost is too high. The cost of borrowing was too high. We are still under kind of COVID restrictions where you can't necessarily evict based off of some things. So it's a little difficult for a lot of investors right now to do that. If you're going to house hack, that can work. But keep in mind, you're going to be the landlord. So you're dealing with tenants unless you're going to hire a property manager. Now you're not only getting the rents that you need, but you're paying somebody to essentially, manage your project. So it doesn't work in every state and it doesn't work in every situation. You just have to make sure that you know the numbers like the back of your hand before you make that decision.
Okay. Done. Is house hacking, multifamily the answer to all of this? Like, is that what every first-time home buyer should do?
All right. So I'm not going to say that's what every first-time home buyer should do. It could be a great strategy, like Dietrich said, and you said that you're educated on what you're doing. If you got property management lined up, if you got money saved to take care of the incidentals, if you know how to get rid of a tenant, if you know how to get tenants, it could be great. It's a strategy that's good for single people, just starting out in life that have all those things together. They have a team. But at the end of the day, the first form of house hacking used to be, when you may have moved in grandmother or mom and had her check help support the bills, right? Or you moved in a child, you let your kids stay longer. Not to go off the deep end, but when you look at other groups, their form of house hacking is actually multifamily housing, right? I deal with a lot of different demographics, and you see how they've been able to develop wealth. They may walk in, it may be mom, husband, a husband, wife, mom, granddad, aunt, and the kids. Older kids live together and they move up, save up, and they buy a house that they put the down payment on for the child that just got out of college or just started a career. So it's different ways to house hack, and don't get caught up in the social media hype. House hacking is popular. I know you guys see a lot of YouTube infomercials, popular big channels that tell you to house hack and all of that stuff because those are high ticket items that get you to click views, and that's how they make money. Understand that you have to figure out what strategy is going to be best for you. That could be a single family where you just live with your mom, or maybe you need to get married, just different things. It's my opinion.
Your opinion, yes. And I definitely left my mom's house too early. As soon as I graduated from college, I was out. I should have saved, stacked my money, stayed in her basement until I had everything together. So if you're still living at home, live at home. Don't be a bum though. I wasn't a bum.
Right.
Like I was working, I was contributing. Don't be a bum, but I could have saved a lot more money if I would have stayed longer in my mom's house. Great advice. All right, we're gonna just, because we didn't talk about this, that'll be our last question about buying a house now. They're waiting on the crash. And I did my video yesterday, and I'm going to say this. I just think everything's volatile right now. Like everything's happening right now. Like everything is up today, 6% today. It's 5.8. To me, we're in a volatile time. I think it will even out, but I still don't think it's going to be a crash. A crash is going to be 20% or more, I think is defined as a crash in home values dropping. And even if it does, if it drops 20% or more, that interest rate still might be higher. So the total cost is going to be more expensive for you. So if you're following some of the basic rules of not, buying once you have money, you have savings, you're doing things the right way, you'll be fine over time. I don't want if things drop how you want them to drop, investors are going to buy all that stuff cash and you're still going to be out. So you have to have a plan in place that's going to work for you. Your only plan can't be, I'll be able to afford once everything crashes. And it's going to have to crash significantly for that to happen. Right. So I'll let everybody end on that question. So Dietrich is next. Should everybody just wait till everything crashes and buy their house at a cheaper price?
So you really hit the nail on the head. If we had a crystal ball for everybody who asked us this question and we could answer it with 100% certainty, we'd probably all not be on YouTube living someplace on a beach someplace, yes, just living it up. You cannot time the market. No matter what anybody tells you, you cannot time this market because there's going to be moments of uncertainty, aka COVID. Nobody knew that was coming. So it's impossible to say whether the right time is now or the right time is later. If you're expecting the crash to come, and that's going to be the sign for you to go, oh, I'm going to wait and I'm going to get in when everything crashes. Well, you and everybody else and their grandmother are going to be trying to get in when the market crashes. Guess what happens then? You just increase, all that demand just came right back. And if we haven't built enough inventory, because that's the key word in all of this, inventory. We don't have enough supply right now to meet all of the demand that's out there. If we did have a crash and prices came tumbling down, you're going to see a lot of people flood back into the market. Well, we still don't have enough inventory. So what's going to happen? Those prices are going to slowly creep right back up. And if interest rates don't calm down, you're going to be paying more for the cost of the house and more for the mortgage, just in terms of the interest rate. So there's really no right time to buy across the board. It's just, is it the right time for you to purchase?
Okay, good. Done. I'll let you end on that question.
Yeah, so at the end of the day, waiting on a crash is probably not going to help you. Let me just put this in perspective for you. Today, I quoted a person with $100,000 down on a $400,000 purchase with a 710 credit score, 7.125% on their interest rate. I want you to understand that a year ago, that same person would have got approximately a 2.97%. All that means for you is this person is now paying about $600 more per month. So if prices went down 20 to 30%, they're still going to be paying about $150 per month more on a cheaper house or a lower cost house. So that means actually absolutely nothing. That's just propaganda to get you, again, clicks and views, get you excited. Like Dietrich said, If the time is right for you to purchase a house, you're ready to start planning for your future, you need that stability. Your home is not an ATM. What is the house going to do for you? You have children. Is it in a good school district? Are you looking for a lower crime area? Do you want to have your kids around certain demographics where they could potentially do different business in the future? Do you need to grow a business or something like that? Do you need better for yourself? What are you looking for your house? Don't look at the prices because, again, to beat a dead horse, your house is not an ATM. It's not the stock market. You're not rolling dice. That's my answer.
Very good answer. And we'll leave it at that. Gentlemen, thank you so much. This has been a great live. We actually did much longer than I normally do. So I appreciate you staying longer with me. I'll have all of the information in the comments. Thank you so much. Everybody have a great night.